There is a beauty in humanity's greatest tragedy. The same patterns repeat throughout time as an evolutionary process inherent to our being. Humanity's social systems, it seems, follow evolutionary patterns just as biological life forms. Now we appear to be reaching the end of one of the most fundamental evolutionary patterns that we have lived with throughout our history. First, a fundamental problem arises. Typically, this problem emerges from the complexities baked into the solutions that society had arrived at in response to the previous fundamental problem encountered. Societies tend to look to the past, seeking out what it had done the last time all seemed to be working. The society will then search for novel solutions, search for some new mechanism to solve its problem. And yet, invariably, there is complexity inherent to the solution which embeds contradictions, limitations, and self-sabotage. The solution contains within it the seeds of its own future destruction, and thus the inherent contradictions within the solution become the basis of the next problem. To illustrate this point, one may look at the problems England faced in the early modern period, as the problems within its feudal fiscal structures were addressed with mechanisms of prototypal syndicated sovereign debt and the innovation of debt equity swaps. This contained within it the mechanism which would unravel into the South Sea bubble and the crises of the early Hanoverian period. This pattern goes far deeper than just economics, however. One could look even deeper still in English history to see the problems of the breakdown of the feudal order, which was solved with novel religious and scientific innovations, as well as an ascendant parliament, a solution which itself yielded religious turmoil and civil war. A problem solved with restoration, a solution which contained more complex sovereign debt, new religious systems, and the Enlightenment. Europe faced the problem of the breakdown of the authority of the Church, the ability for feudal structures to maintain over increasingly complex kingdoms, and increasingly sophisticated trade needs. It solved this with Reformation, a period of increasingly sophisticated arrangements between principalities, a new system of international banking, and the birth of modern credit. This would result in the world of the 30 Years' War, itself solved with Westphalia, the nation-state, and the Enlightenment, developments which themselves led us to new wars, societal breakdowns, and the estrangement of people from their homes. It continues on like this throughout history. A problem needs a solution. The solution contains the seeds of a new problem demanding a new solution. Humanity goes through this again and again, always searching for some sort of final resolution. Humanity is always trying to find some way to be rid of its problems, yet it never is. Every time humanity finds a solution, it only creates a new problem. This is the basis of the great cycles that we see repeated throughout time. We see this in business cycles. Great excitement breeds investment and new entrants. Lending opens up, and populations become excited, eager to get in on the action. Ultimately, however, the civilization finds that it was too enthusiastic, that it had made promises that it could not fulfill, that it made loans that would never be repaid. Businesses eventually begin to crash, lending dries up, and activity slows. This period of fear and illiquidity, however, creates new opportunity, and the intrepid find that they can get great return if they lend or strike out into business. Eventually, more will see the large success of these bold early movers and begin to enter in. More credit becomes available, more entrepreneurs take risks, and the economy begins to grow. Ultimately, the supply of credit grows to be very large and liquid, and underwriting standards loosen. As time goes on, interest rates are found to be inadequate to compensate for the true risk inherent within these investments, and the ever looser underwriting is found to have been folly. As cracks begin to form, the market once again finds that it has made loans that cannot be repaid, and so businesses fail. Loans are written down, and the credit supply dries up again, only for the cycle to repeat itself anew. We see patterns like this on the order of empires, the rise of great civilizations who grow to encompass more and more territory, taking more and more into their domain, only to find themselves overstretched. We see this philosophically, as a set of social problems require a novel solution. As these new solutions are created, it seems as though the civilization has found a path forward that will last forever. Yet invariably, the problems and contradictions inherent within the new philosophical order become the basis of its undoing. Lending is ultimately a system of promises. As old problems are solved, the bold make promises. These promises allow economies to flourish, yet always there are promises that cannot be fulfilled. Just as loans go bad at the end of credit cycles, the images of empires are found to be mirages, and the promises of social systems are found to be impossible. What is something like social security, if not a promise, a loan that society has made to itself, telling itself a story of future growth? What is a stock market, if not the promise of a society's economic future, a collective buy-in to a story? What is a government or a ruling class, if not the satisfying of a story that a society has told itself? Whether philosophical, geopolitical, economic, or cultural, it is the same. The stories, the promises are found to be untrue. The end of a social story hits like the philosophical equivalent of a loan portfolio suffering major defaults all at once. Yet just as the bottom of an economic crisis finds itself to be a great time to lend, the end of a social system finds itself to be the best time for new social stories, the new systems. Over the past 4 decades, there has been an unprecedented explosion in the supply of credit following the very high interest rates of the Volcker years. This burst in credit coincided with a series of very transformational financial innovations. The first major innovation was the expansion of the credit market to allow lower quality borrowers to issue bonds which would come to be known as junk bonds. Next, we begin to see the expansion of the leveraged buyout strategy. Highly levered strategies became the norm as interest rates were perpetually dropping, and the credit investor found that he was always on top as refinancing was easy and reliable. For decade upon decade, duration remained always favorable to the investor. As we entered into the 21st century, interest rates had become quite low, and leverage had ramped up to an unsustainable level. Yet the financial crisis of 2008 would force rapid and extreme responses as institutions fell and investors scrambled to save their portfolios. As the world began to limp out of the financial crisis, institutional investors found themselves in a new predicament. The very low interest rate environment they had emerged into had caused the return on bonds to be inadequate for the needs of many institutional funds. No longer could a defined benefit pension plan meet its obligations by simply investing in bonds, and as inflation demanded sufficient returns to outrun the erosion of purchasing power of currency, higher returns were required. The solution presented was alternative investments. Institutional investment consultants, as though a hive mind, enthusiastically told large funds to invest increasingly large allocations in alternative strategies like hedge funds. Well-performing hedge funds gave their investors phenomenal returns, yet unfortunately for the hedge fund investor, many of the best strategies required there to be small pools of capital deployed and began to break down when AUM got too large. Thus, if a hedge fund truly found a way to outperform substantially, its edge would either erode away as the business grew, or it would have to refuse new investors and close the fund. Despite these problems, the low interest rate environment that had forced investors further out on the risk curve would come with some new opportunities. A seemingly perfect solution to everyone's problem would emerge: private market funds. As private equity proliferated rapidly, along with it expanded private lending. The premise behind private credit was simple enough, and for our purposes here, we will focus on the strategy of direct lending, non-bank lenders making loans, taking on concentration and liquidity risk, with the promise of compensation above broadly syndicated loans. It appeared as though these private credit strategies were able to provide investors with the returns that they demanded. Institutional investors, encouraged and led around by their consultants, began to pour large quantities of institutional money into these private credit funds. These funds became major lenders, not only to private equity funds and portfolio companies, but to a great many borrowers around the world. What happens when there is a great exuberance and money rushes into an investment that seems to be perfect? The the positives touted everywhere while the risks are yet unproven. Investors become careless. As increasingly larger pools of institutional money provided increasingly larger commitments to private credit funds, these lenders found that they had to continue to provide the high returns investors had come to expect, and that they had to deploy all of the capital they had received. For the private credit managers, there was simply no option to sit on the sidelines and wait for the best opportunities. They had to chase yield, and they had to do so with every dollar in their funds. If you ran a private credit fund, you could not turn to your LPs and say, "I don't see anything that I like, so I'll be parking money in treasuries until an appropriate opportunity comes along." These private credit general partners were being paid to fund private credit investments, and they were being paid very high fees to do so. As they were presented more and more money, they had to make more and more loans, and so, as they were forced to invest more and more, underwriting standards dropped. And as has always been the case, faulty loans were written with insufficient compensation. All the institutional universe was being assured by the expert consultants that their money was safe, and that private credit was a remarkable investment that would yield high returns, with risk well accounted for. Firemen's pensions, charitable foundations, municipal retirement plans, and so many funds who relied on the expertise of these consultants were all being assured that private credit was an excellent, robust investment, that the geniuses of Wall Street had found a way to make credit more profitable than ever. So had they really found a way to get extra return without the commensurate risk? Or was humanity doing what it has always done, excitedly piling money into bets whose risk they don't truly understand and being careless? Today, concerns are rising around private loan portfolios and redemption requests from their investors. This is just one manifestation of that constant repeating pattern that has existed for all of humanity's history. Today we appear to be at the inflection point of not only one cycle, but many. I'm not about to make an argument for a cyclical model of history, yet it does appear that there is certainly at least some degree of cyclicality within human behavior. Since the Peace of Westphalia, the Western world has been operating on a model that would form into the liberal model of today. We have seen centuries of commercial expansion and ever more financial sophistication. As the assertions of liberalism demanded increasingly complex bureaucratic systems, we came to build a system that values rules and large institutions filled with administrators. Liberal civilization came to believe that vast bureaucratic apparatuses enforcing universal rules across universal blank slate tabula rasa man had created the ultimate solution to humanity's problems of economic hardship and conflict. So what is more likely? Did we solve all of history's problems with liberal bureaucracy, financialization, globalism, and international rules? Or did we solve the problems of a particular time and place, presenting ourselves with a system of novel complexity, which had within it the seeds of its own undoing? Today, it is becoming increasingly evident that the systems we have lived under are breaking down. Private credit, the rules-based order, the administrative state, and liberalism are not separate phenomena, and are all common to our philosophical operating system. Just as the nation-state and the Enlightenment were presented inseparably as the solution to the religious turmoil of the 30 Years' War, private credit was presented as the solution to the perpetually low interest rate environment, solutions natural to the liberal mind. They are on different scales, and within different arenas, but are manifestations of the same thing. Our pattern of problem, solution, problem is reaching yet another inflection point where the old solution is now the present problem. The liberal world order presented globalization as a solution based on the premise of comparative advantage and the elevation of financial capital above labor. Globalization flows quite naturally from liberalism. Tabula rasa, the blank slate man, makes logical the notion of an international brotherhood, where borders erode away, and where liberalism is universal. If all man is inherently the same, just waiting to be elevated to the enlightened liberal mind, then naturally the liberal would reason that if capital, and thereby prosperity, were to flow around a world without borders, then everyone would end up like the Western liberal, believing and behaving as he does. The world since 2020 has been a radical departure from what we have seen since the end of the Second World War. Interest rates have risen sharply as the multi-decade credit bull market came to an end. Global dollar liquidity began to break down, and increasingly, globalization and the rules-based order have come under question, with entirely different philosophies presented as alternatives to liberal globalism. The cracks in Europe have been widening, and it has become evident that the European Central Bank has been losing control over its most important yield curves, that of the German Bund and the French OAT. Similar problems exist in the United Kingdom, and in all of these nations, internal tension and turmoil have been steadily mounting. For generations, commodity pricing and flow have been dominated by the financial hubs built by the old European empires. Yet today, a new wave of sovereigntist sentiment seeks to strike right at the heart of that system, which has been taken as given for so very long. The world is changing. What we are facing isn't simply the end of a credit cycle, it's the end of a macro system. So what is this private credit problem on the grand scale? It is the end of the idea that ever-declining interest rates and ever-abundant US dollar credit can create a perpetual state of financial abundance. It is the end of the idea that bureaucratic complexity can become so complex as to overcome the fundamental realities of material constraints. It is the end of globalization and tabula rasa, the idea that everyone is the same, only made different by material constraints, and are deep down only waiting to be elevated to the enlightened end state of the Western liberal. It is the end of the idea that the proper role of a nation's institutions is to maximize the return to capital anywhere in the world, and that the nation is not only an afterthought, but something dirty and backward. These phenomena are all microcosm and macrocosm of the same process. The liberal system, along with its stories, is coming to a close. Let us focus on the matter of the credit cycle, and think through what would happen if redemption requests were to grow sufficiently large so as to engender a crisis. What one would immediately see is private credit investors being forced to liquidate their positions into the secondary markets. These liquidations would almost certainly necessitate steep write-downs of credit portfolios. Some have made the argument that LPs may choose to liquidate publicly traded bonds and bond funds instead in an effort to shift their portfolio allocations. However, this has not appeared at all in markets thus far, and remains unsubstantiated conjecture. The pressure appears to be on private credit itself, and the more investors are told that they cannot take their money out, the more they want to. The private market investment industry has been based upon opaque portfolios, and the charging of very high fees based upon the valuations of said opaque assets. The managers are paid for the high valuations they present to investors, and are thus incentivized to report assets at high valuations. We have increasingly seen funds extend lifetimes, pass investments from one fund to the next, or otherwise hold cash back from investors while insisting that the large valuations they gave to them are justified. In a rush for the exit scenario, the fact that private credit funds so often find that they must artificially extend to continue to justify their lofty valuations necessitates that write-downs would be significant and devastating. This pattern would no doubt create an increased panic across investors, and redemption requests would grow even higher. A vicious cycle of fear, sell-offs, write-downs, fear, and so on. No doubt the credit fund managers would attempt to avert these redemptions and the ensuing substantial losses by insisting that only a small amount of investment capital could be withdrawn at a given time, limiting redemptions. If such a panic were sufficient, however, then a mass of enough LPs all demanding liquidations together at once would make these efforts to limit redemptions untenable, and funds would be forced to liquidate, to some degree. Owing to the illiquidity of these portfolios, the ensuing write-downs would by their nature be significant. A substantial sell-off in private loans would send shockwaves throughout the global economy. As lending dries up and fewer investors step in to fund future vintages, there would likely be a significant contraction to the global credit supply. While the hits taken by these investors would be significant, it is the nature of these investors that is particularly troubling. The insurance companies have increasingly become highly allocated to private market funds, and would be particularly sensitive to such a shock. While this could be quite damaging, commercial banks have been acting as major lenders to private credit funds. Should the commercial banks begin to take hits from this exposure, then the real shock waves would hit. The exposure of banks and insurers would greatly amplify any contraction in the credit supply, putting great pressure on the global economy as an illiquidity cascade sweeps the world, with each marginal dollar coming under more and more strain. If credit losses were to become sufficiently large, or if redemption requests were to reach such sufficient volume, then the public, who does not yet know of this industry's existence, would no doubt be decrying the mismanagement and greed of shadow banks in quite short order. Let us now return to looking at Europe. The post-war era has seen a strategy across Europe based upon reliance on the United States for defense, and as the basis of Eurodollar credit. As the rules-based order evaporates and fractures within NATO expand, this reliance upon the United States will become ever riskier and more of a liability. European economies are weakening. They do not have sufficient energy supplies, and they have built themselves upon the belief that rapid economic development is socially destabilizing. Following the Second World War, the countries of Western Europe have sought steady yet minimal growth, minimal social mobility, and to placate their populations with large welfare states, low instability, and high comfort and mediocrity, as their productive capacities diminish. They came to rely on financial mechanisms, drawing wealth from their vast capacity to rehypothecate US dollars. Some in Europe made themselves great wealth by printing dollars in the Eurodollar credit facilities, yet this printing in turn reduced the purchasing power of the American workers. Those in the United States who were not able to peg their wealth to global investments found that their quality of life was getting worse and worse. The family of the 1950s and 60s, who had had a quite comfortable middle-class life working industrial jobs, ended up displaced by the service sector classes who had their money in equities, global credit, or increasingly, private market investments. This class did quite well, while some became fabulously wealthy. Yet the worker found that he was out of a job, and that his home was rotting from the very phenomenon that had propelled the wealth of European financiers. The Eurodollar engine kept global bankers wealthy, white-collar professionals comfortable, Europeans placated, and European states extending their delusions, all while making more and more Americans poorer. This ability to print dollars and steer American capital offshore allowed for the large welfare states found across Western Europe. As time went on, however, this financial growth began to slip away from the Europeans, and Europe found that it needed a way to artificially prop itself up on paper. We would begin to see enormous waves of immigration into Europe, while the credit facilities of the Eurodollar banks issued credit. This credit ultimately turning around as taxes to the European governments, and these governments paying out very large transfers to the now increasingly foreign populations. A perpetual debt and tax system, which used transfer payments to foreigners for mass and velocity, with the dollar as its cash cow. A cycle of artificially propped up GDP was born in countries like Germany, France, and the United Kingdom, able to continually issue bonds at low interest rates, often forcing domestic institutions to be their buyers, all while quality of life in Europe declined. On paper, Europe's finances remained strong, while their elite became ever more detached, believing that they really were in the end of history. Many across Europe began to abandon their energy sectors. To them, globalization seemed permanent, and they imagined that the state could perpetually finance itself, while the United States would always protect them and issue more bonds as fuel for the machine, going deeper and deeper into debt to satisfy the demands of the Eurodollar markets. Now this model is fundamentally in question, and offshore dollars are being separated from those onshore. Yield curves are getting away from the European Central Bank and the Bank of England. The rules-based order is faltering. Sovereign debt spreads are moving against the European Union. LIBOR is gone, and something as simple as redemption requests in private credit funds could quite easily become a global dollar liquidity shock. A breakdown of belief in Wall Street's story of beating risk with private credit seems like it's just one small thing, but so easily the breakdown in that story could dry up credit, dry up liquidity, and in turn dry up the post-war order. The breakdown in society's stories does a lot more than shift sentiments. It changes fundamental behaviors. It can be very difficult to model just how much one story holds up in a society, but every society is built upon its tales. Keeping all this in mind, let's look at the Middle East. For decades, there has been a simple and reliable system, a highly volatile oil market, which passes through dangerous and closable choke points protected by the United States Navy. The United States bears the cost and ensures that global energy markets remain supplied. Yet, as there is substantial instability in the region, every time there is a flare-up, oil volatility spikes. Prices rise higher in the futures market, and the maritime insurers profit immensely. Going back centuries, one of the greatest intelligence organizations in the world has been the Agents of Lloyd's. This network grew out of necessity, as shippers and financiers met in London to discuss their industry, exchanging intelligence from what they observed across the seas. In order to properly price their contracts, it was very important to have knowledge of what was going on across global shipping lanes. As Lloyd's insurance market grew, so too did this intelligence gathering apparatus. Lloyd's agents became a vast and sprawling global network throughout the 19th century, as the Victorian British Empire based itself upon its maritime power and extensive shipping networks. By the time of the 20th century, the network of Lloyd's agents had become so sophisticated that MI6 was based in part upon it. The sheer access to information obtained by the nexus of these agents and British intelligence made it so that during enormous global conflicts such as the World Wars, Lloyd's continued to ensure shipping. Lloyd's had such an understanding of what was happening in risky trade zones that they simply adjusted their premiums to compensate for the risk. They would provide the information that they had of global cargo and routes to MI6 and Royal Navy intelligence, and the intelligence agencies would in turn provide Lloyd's with their own information, creating a robust cycle of information, the best in the world. One thing that made having access to British intelligence information so powerful is that in many cases volatility events were controlled by the agencies themselves, allowing Lloyd's to have information of risk events that were yet to come. British agencies set up militant, religious, political, and other disruptive networks across the world as they pulled back from their territorial empire, leaving manipulable remnants to ensure that they could retain influence, even when nominally they had vacated. Global chaos was not truly a risk to the business model of Lloyd's, but simply an environment which allowed for higher fees. With such detailed knowledge and influence, chaos became profit. This has all changed in only the past few months. As conflict escalated in Iran, for the first time ever Lloyd's stopped insuring ships traveling through the Persian Gulf. The United States responded by creating their own insurance pool, offering insurance to shippers and the protection of the United States Navy. This was a striking reversal of the status quo. The Navy would no longer be a cost sink for the United States, but a profit center, undermining Lloyd's insurers. The greatly threatened Lloyd's would respond by threatening shipping companies, giving ultimatums that they would never be insured again if they went with the American offer. So now two very different models of global shipping and trade are on the table, as global chaos agitators have always been quite closely linked with the agencies of Britain and France. This is truly a clash of systems. One need only look at the origins of the Iranian regime, and it will become vividly evident that this linkage has played a significant role over the past century. It is no great curiosity, therefore, why these intelligence networks seem to always have the scoop on risk events in the region, and why Lloyd's seems to always know precisely what premiums should be charged in these risky zones. This new model offered by the United States, however, seeks to see the volatility in oil decreased, and for the dominant oil pricing benchmark of the world to become the US WTI. High oil prices are troubling enough for industry, yet what has truly disrupted economic development and reasonable goods pricing for the past many decades has been the volatility and uncertainty in oil prices. Industry can deal with high oil prices, but has much more difficulty with volatile oil that they cannot predict. Yet if one makes his money in the futures, then volatility is preferential. In this world, countries would be responsible for protecting their own shipping, or they would have to compensate the United States to do so on their behalf. The global agitators of chaos would be eliminated, and the United States would become the dominant player in oil. The status quo model of agitators which can be turned on and off. The United States is the protector of global shipping, bearing the costs but none of the rewards. The easily manipulated Brent futures market dominant over oil pricing. Insurers plugged into intelligence. And the agitators themselves pulling profit off of this market is one vision of the future, the same as the past. The new model favors the US, steady and reliable markets, and commodity producers, while the old favors toll booth financiers, insurance companies, chaos agitators, and those who can pull money off of futures. And so we are now not only at an inflection point, but a confluence of inflection points. The credit cycle appears to be coming to an end. Simply too much money has chased too few good investments. Institutional money has blindly piled into credit funds, and risk has been inadequately compensated. The dollar liquidity pool which has been created is far in excess of the reality it was built for. The promises made do not match the reality to deliver. The cycle of the global order is coming to an end as the rules-based order has proven that it can no longer pretend to govern. While so many have grown ideologically and emotionally attached to the rules-based order, even a cursory glance at the conflicts in Ukraine or the Middle East plainly tell that the world responds to the ability to wield military force, and not sternly worded letters drafted by a committee of pampered diplomats at the UN. Truly, power politics has always been at play, and the rules merely a pretense to present a more pleasing justification for the global hegemon. The large managerial bureaucratic systems as well appear to be reaching their limits, as the systems of the state have become more and more complex, with more and more layers of bureaucracy within them. This complexity, this redundancy, these self-contradictory rules, and the sheer friction of excessive regulation have made these systems counterproductive and often detrimental. To take one example, Americans did not simply lose the ability to build ships and train lines in only a couple generations. This erosion of the ability to build was a choice, and it was embedded into the administrative systems. Yet Americans as well have the choice to take back the ability and build once again. This is the same for national and international bureaucracies. This complexity stopped providing benefit at some point, and now bureaucracy exists for bureaucracy's sake. As we go forward, there will no doubt be something quite different created. Perhaps we will see novel systems innovations like a blockchain-type financial mechanism, something where the internal logic of the data provides a system with its own truth and proof. We could quite likely see technological systems replace bureaucratic ones, where the truth of the system is the logic and the data, and not credentials and social complexity. We will likely see systems of understanding and cooperation based upon mutual understandings of sovereignty between global powers. Power politics as a check on power politics, and not UN decrees and champagne swishing in French palaces. One can look to the recent meeting between Donald Trump and Xi Jinping. The United States and China appear to be finding alignment and understanding, where the old globalist model, born from the old empires, could only imagine an inevitable collision into war. There is another future, and all it takes is the decision to pursue it. We will no doubt see a great many new systems, for the alternative is to simply let the old metastasize into destructive mechanisms that yield nothing. We must innovate if we wish a future, and fortunately, we have always risen to the occasion. On top of all of these cracks in the machine, the liberal philosophical framework itself is no longer sufficient for today's world. No doubt many will be frightened at this proposition. Many have come to believe that liberalism is synonymous with moral, but it was a philosophy designed for a particular time, in a particular place, as a solution to a set of particular problems. Liberalism as a social operating system assumed a European Christian ethos undergirding society, with liberalism itself incapable of underlaying a society alone. It was built for a world of sailing ships, a world where Catholic and Protestant was the most fundamental divide, a world where information was transmitted in books and pamphlets, and where travel across continents was not only long, but often perilous. Liberal philosophy cannot account for nuclear weapons. It cannot account for airplanes, and it cannot account for the internet. As the social philosophical conflicts of the past decade have been resolving, many look back on this era as the end of woke. But as the extreme conclusions of liberal orthodoxy became questioned and opposed, it in turn changed something deeper within people. The questioning of liberal assumptions did not stop there, but instead a door was opened to asking fundamental questions of our philosophical operating system. If the liberal orthodoxy and those who held its highest credentials in its highest institutions could insist plain falsehoods, like that men and women were just a myth, then perhaps more and older assumptions that society had passively accepted were as well just as wrong. Society began to question in ways it hadn't in generations. Belief in liberalism is fading away, as it has become increasingly evident that the differences between peoples is actually quite important to how the world operates, and that all of the world are not simply liberals in waiting. Operating under tabula rasa universalism, liberalism set out to impose itself across the world, believing that all would be just like the Western liberal if economic conditions were changed to match the West. Liberalism became materialism, and simply lost sight of what actually matters to people and what makes a people. Over time, people became nothing more than economic units, and peoples, groups of the gullible, who did not yet know of their destiny as atomized individuals, from nowhere and bonded to nothing. What happened is that the Western liberal found stronger and stronger resistance across the world. He was not viewed as the enlightened liberator, but as the invader who sought to impose his will on everyone and refused to leave people alone. In the case of China, for example, while the Western liberal assumed that they would become more liberal and more Western as they became wealthier, it was actually found that as China became wealthier, it became more firm in Chinese characteristics and more ardent in its rejection of liberalism. This great economic success came to be viewed as proof that the Chinese system and Chinese civilization were successful. Why should the Chinese have thought that they should radically change to something completely alien from the culture they had loved for millennia, and which had brought them to this point? Human societies require moral operating systems, and a world of cosmopolitan, atomized individuals bonded to nothing but the state erodes away the very foundation that was necessary to create prosperity in the first place. Liberalism always assumed that the Christian ethical framework, those social bonds, and those shared understandings would always be there. Yet as the liberal administrative state totalized more and more, and Western societies became more secular and materialistic, the foundations that prosperity had been built on turned to sand. Globalism is being reversed. Financialization has hit its limit. Bureaucracy is breaking apart under the tension of its sheer redundant sclerotic mass. Sovereign peoples are rising in opposition to globalist universalism. The rules-based order has been proven to be nothing but branding, a velvet glove for the iron fist of raw power that has always been the one true force in geopolitics. The solutions created for the world of the 30 Years' War are simply too disconnected from a world where people can travel across the globe in only a matter of hours, where everyone can speak to each other instantaneously and constantly online across languages, and where humanity has the ability to destroy the world many times over with nuclear weapons. Though it may be frightening to think of the philosophical order, the economic order, the political order, and the international order breaking apart, the only other possibility is to march blindly to destruction without attempting any solutions. Change might be frightening, but this process has sustained and grown humanity for millennia, and it can do so again. The past decade has been in great part a social Cold War between those who are attempting to hold on to the old order, ignore the problems, and blame the messengers who portend its end, and those who have been failed by the old system, or otherwise can see that change is coming, and or preferable. The end of the old order has become increasingly visible to more and more people over the past few years, as we have entered into a new stage, an inflection point. We have entered into a time of revelation, and a time for deciding. There will be no further credit system, and nations will need to decide if they will steal the collateral of others, as has often been accomplished through war, collapse in order to reset, or find some new path under a new system. The Middle East will either continue to sustain the chaos premium in highly volatile oil, passing through manipulated choke points, or all of these decades of conflict will come to an end, in a much more decisive manner, with new agreements forged. Europe will be forced to decide if it will continue with its EU project and mass migration, whether the future of the continent is in digital IDs, capital controls, strict speech policing, and social destruction, or if the globalist project will end, displacing old elites and forming new ones, the cultures of Europe allowed to rebuild, while the financial operating system of the old empires comes to an end. We are at the tipping point. The recent events in Iran have made it so that it can be no other way. There is no possibility of simply walking away and having everything be calm and static. There is no possibility that the market and supply for the foundational commodities of the world will continue through the system of choke points and toll booths, benefiting futures market participants and insurers as it has for centuries. We are now at the time for deciding in the Middle East. Conflicts will either end decisively with the oil market fundamentally changed, squishing out the Brent contract and eliminating the chaos premium, or it will plunge into a much deeper chaos, destroying everything in its path. As this great credit cycle reaches an end, European nations will either seek refuge in a sort of economic nationalism, each leader claiming that Europe is in dire straits, but that they can save their own nation, or nations will melt down together, perhaps seeking conflict as a way out, or perhaps going out with a whimper. There is no possibility of simply running out the debt extraction system much further. We will either see sovereign spheres in a model of sovereign nations benefiting via trade and investment, or conflict will deepen, and global supply chains will break down. The moves over the coming months will begin to tell us what the future will look like, for there are no more avenues of extending. There is only deciding. One should look to the movements of sovereign spreads. If one sees attraction of capital out of Europe and a flight to safety, then one can assume that European credit is breaking down. One should look to redemption requests in private credit, and the moves that have already been occurring in publicly traded financials and BDCs. One should look to the Brent WTI spread, for the division between the financial futures market representing the European system and the physically deliverable American oil, representing the new sovereign hard asset-backed world. Those who have benefited from the old arrangements and the old systems would like to extend, but they cannot. Those who understand this may seek destruction, hoping to abscond with wealth in the process, but how this future plays out is not their decision. The future is the decision of the peoples of the world, and to great extent, what the United States and China choose. The system as it has been will not continue, but we don't yet know what the future will look like. It is my firm suspicion, however, that we will begin to see more signs quite shortly. In fact, we've already begun to see indicators, which have become increasingly more frequent and significant in scale. We are reaching the end of a solution, and we will need to create our own for our own age. We may end the chaos premium. We may trade in a world of sovereign spheres, bound by investment and mutual interest. We may see data and internal systems logic replace bureaucracies. We may see an end to globalism and global liberalism, and the rise of some new philosophy of mutual respect for different peoples and differences. We may see the wild dollar liquidity boom come to an end, and a system of hard assets and more serious collateral replace it to tether the economy of the future better to reality. We may see the debt theft system end and industry rise, where families once again prosper. These are not different problems all coming to a head, but are really one problem. This is the problem of the system itself. This is what happens when the complexity built off of a rule set stumbles upon its own inherent instability and contradictions. Bureaucratic rules within finance are just a reflection of the rules-based order in geopolitics. Credit expansion and global liquidity are just manifestations of globalism. These are all manifestations of the belief in liberalism, and the belief that the liberal world order is the end state at the end of history, when humanity has nowhere else to go and no way to possibly improve upon itself. There are no more patches, and there's no new iteration of the liberal order. There is no new and even more arcane and opaque alternative investment to absorb the excess liquidity in the system. What there is deciding. It is frightening to live in such a time. Many who have grown quite comfortable and attached to the system they know cannot imagine anything else, and fear that change should mean horrors. When one looks at the countless times that this has happened in history, however, it becomes rather amusing. This is always how people feel, and no doubt our descendants will one day feel the same, when we have created for them a world that they could not imagine any other way. Much is being revealed as narratives and delusions of the old order are falling apart. More of the apparatus underlying the system is becoming exposed to the public eye. As the stories of the system go, so does belief in it. Soon we will tell a new story, one with new mistakes, new promises that cannot be fulfilled, new beliefs, and new narratives and lies that bind us. But this is simply what we do. Human civilizations tell themselves stories so that they can build together. Some refer to this pattern as something like a rhythm, history that rhymes. This may be an elegant description in a poetic sense, but to great extent perhaps it is best to think of this as an evolutionary process. There is no end state. There is no utopia at the end. There is no future without its villains, without its pain, and without its mistakes. Yet each time we iterate, each time we find something new. We are going through a great change, and we are learning much that has been kept below the surface for decades. Yet now we have a very large role to play. Now is the time for us to decide.